Hey everybody, Dave Warden here at Triumph Coaching Group. I just want to say thank you for watching our recording of our training, Numbers Don't Lie, Mastering Metrics for Optimal Business Performance. I truly feel you're going to get a lot of great, awesome information with these 6 metrics that you should be monitoring and tracking in your business. So without much more to say, let's get into the training. So who is Dave Warden, right? I have 17 years of finance and executive leadership experience with another 7 years helping and consulting small business owners to help them level up and reach their goals. I have a true passion for helping the small business owner really educate and give them the strategies and the growth tactics that they need from big corporate world and how we can apply that into their business to make them more successful. I'm in Cleveland, Ohio, and I have married with 3 kids who take up a lot of time as they are all turning into teenagers and growing up so quickly. So it's amazing. We also have 3 dogs and 2 cats. And I will apologize if you hear some dogs barking in the background, as my wife has a dog kennel that she also runs out of her house as well. So it's a wonderful time to be in our household. So what are we going to cover today? So we're going to talk through why do your business metrics matter? Right? We're going to start off with a critical role of how they play and how those metrics then play into your business strategy. We're then going to dissect 6 key financial metrics that every business owner should know and be tracking and keep on their radar. We'll also look at a couple real world examples and discuss some common pitfalls that may skew your business perspective. And then finally, we're going to walk through some Q&A. But the Q&As in this recording is going to be more in the form of, I'm going to give you my contact information at the end of this video, and you can send me any questions that you have on any of the topics that we talked about here, and we can talk through those. So some of our objectives today are we want to understand the importance of each metric. We want to make sure that you understand why and what the importance of every metric is. Learn how that you can calculate and interpret these key metrics. And then finally, learn how to apply these into your business decision making. So first, we want to talk about what is the power of each one of these metrics and why are they vital for your small business? So metrics give you a business compass, right? These numbers serve as a compass. They guide you towards or away from certain strategies and actions in your business. So by knowing the data and the information that goes into these metrics, you can serve to be better armed with weapons to make better decisions in your business. Quantifying your business health. These metrics will allow you to quantify the health of your business, turning abstract concepts into measurable indicators. And what do we mean by that, right? So, knowing if you just say business is good, you'll actually have data to back that up by saying, well, yeah, we're doing great. We have a 15% net profit margin. Our gross profit is above our industry average and we are doing fantastic, versus just saying great. And when people ask you to quantify that, you won't have the data behind it. They really do help you by driving your strategic decisions, right? By understanding your metrics, it's not just a task that you have to go through. Each of these numbers drive real world decisions in every facet of your business. So by knowing them, you can really begin to make better quality strategic decisions in your business. You can identify your strengths and weaknesses. Metrics help you objectively identify both your business's strengths and weaknesses by enabled focused improvements. These metrics will be a start, it's not an encompass, but these 6 will give you a starting guide to where you need to focus your attention on your business and making improvements. And then finally, risk management and planning. Ultimately, these various metrics collectively contribute to better risk assessments and future planning, providing a data-backed foundation for your important decision-making. So let's talk about what are those 6 key cornerstone metrics that we're going to be talking about today. So the first one is revenue growth rate. Then we're going to talk about gross profit margin and then net profit margin. And we're going to talk about your customer lifetime value. We're going to talk about your customer acquisition cost. And then finally, we're going to talk about what is ROI. And some of these terms you may have heard before being a business owner, but if you haven't, I'm going to teach you how you can calculate them and what they mean and how they're important in each of your business decisions. So let's talk about revenue growth rate, often considered the pulse of your business. This single metric can give you a snapshot of how your business is growing or contracting over a specified period of time. So revenue growth rate measures the percentage of an increase or a decrease in your company's revenue between two periods. So it may be you're looking at year over year, you may be looking quarter over quarter, but you take your revenue growth over those two periods or loss, and that'll tell you whether you're positive or negative. So how do you calculate, right? So you calculate your revenue growth rate by taking your current revenue. So let's say this may be better with an example here. So your current revenue is $120,000. You're then going to subtract out your previous revenue. So $100,000 was, let's say, last quarter's revenue. So you had an increase over quarter to quarter of a $20,000 increase. So you take that increase, 20,000, which is this number right here. You're then going to divide that by the previous revenue of $100,000. And then you multiply that by 100 to get a percentage. So in this case, when you take 20,000 divided by 100,000, multiplied by 100, you get a 20% revenue growth rate. And again, things to keep in mind here is if you have a positive, this rate right here is positive, your strategies are working. The things that you're doing to grow are in place, and the customers are buying from you at an increased rate. If it's a negative, this may mean that you need to adjust. You need to review your strategies, right? Because you're contracting. So you had a loss of revenue quarter over quarter. So what is the importance of knowing your revenue growth rate? So this is crucial for understanding kind of the trajectory of where your business is heading. It will help you gauge the effectiveness of your marketing strategies, your product offerings, your customer relationships, your staff. If you have a staff, how effective are they selling to clients? So this gives you a general idea of how well you're doing and how you're trending. And that's a good thing I'll point out at the end of the video, and I'll just mention it here quickly. Trend all of these metrics. Make sure you're tracking them on a regular basis. So how would you use revenue growth rate in your decision making? So for example, let's say you have a consistently high revenue growth rate. This may be a great time, and it will serve as a signal to you that it's a good time to expand. Maybe it's time to consider a new product. Maybe it's time to consider a new location. And it's things that you've been waiting for a sign to do, and without the data, you didn't know when to do it. But now when you look at your periods and you realize you have a positive revenue growth rate in the teens every single quarter for the last 12 quarters, you now have the data behind it to say, this is the time for us to expand. And this is how you can use revenue growth rate when making your decisions. And on the flip side of that, if you have a consistent period or a consistent trend of a negative revenue growth rate, you may now, instead of just feeling like revenue hasn't been the best, you have data behind that, and you can deep dive into that data even more to figure out why has our revenue been declining. Is it a specific product? Is it a specific location? But without knowing the metrics, you don't have that starting point to kind of give you the direction that you need to head. And this is where we talk about the compass, right? It'll tell you where to go. Our next metric is gross profit margin, which is a key indicator in your business's financial cushion, right? Gross profit margin is the percentage of revenue that exceeds the cost of goods sold, and it's calculating using the formula here. So we take our revenue, we then subtract the cost that it takes to produce either that good or service, and then we divide that by our revenue, and again, we multiply that by 100. So let's take, for an example, let's say in company, we have $150,000 of revenue, but it costs us $90,000 to create, right, that product. So for this period, our gross profit is $60,000, which is the 150 minus the $90,000. So we take that 60 and then we divide it by our revenue, which is $150,000. And then when you multiply that by 100, you get a gross profit margin of 40%. So what is the importance of knowing this metric? This metric, the gross profit margin, tells you how effectively and efficiently you're producing and selling your products or services. A high gross profit margin suggests that you have a healthy business model. whereas a low margin could indicate inefficiencies. So when we talk about low or high gross profit margins, it does depend on the industry that you're in. So if you're in a service-based industry where you don't have a lot of cost associated with producing your service, your gross profit margin should be significantly higher than a company who is in a product-based business who has a high cost of goods sold. So the only true comparison when you're looking for, kind of the metric and a baseline for your business is to Google search your industry with the words gross profit margin. This is going to be a great evaluator of where your business currently stands in terms of your gross profit margin. So by doing this, and I do this in our other training, our financial training, which I'll include a link in the description down below of this video, you can watch that, and it's going to show you more about the P&L, more about ways that you can instantly improve your cash flow. And one of the things we talk about in there is evaluating your P&L using this metric and using it against your industry standard. So how would you use your gross profit margin in a decision-making process? So let's say, for an example, you have a gross profit margin and you look up your industry average, and your industry average says that you should have a gross profit margin of 50%. And when you look at your metric from your financial statement, you realize that your gross profit margin is only at 40%. So you're 10% below the industry average for your industry. This is going to be a great indication of you to take a look at your expenses. What is the cost of goods that are going into? What am I paying for? And how can I potentially cut costs? Or do you have the right costs under cost of goods sold? I've seen this with a lot of companies as well, where they're including operating or overhead costs in their cost of goods sold. So it does affect the rate. So making sure you understand the P&L just as much as these metrics play a big portion. But if you're operating at that 10% level, you have a ton of room for improvement, because the law of averages is that 50% of businesses are operating above that mark. So there's 50% of companies within your industry who are better than that 50% mark, which means you have a ton of room for improvement. And a simple 5 to 10% under industry average can result in a 75% increase in your net profit margin. So what you take home at the end of the day, which is our next metric we're going to talk about. So by knowing this metric, you can compare it and understand where you sit with your peers within your industry, which will then lead you to decision making on what strategies you need to do, what costs you need to cut. It'll allow you to do a better review of your P&L statement as well. So just knowing this one margin is impactful to your business, because it does allow you to then evaluate yourself within your competitors. Next, we want to talk about net profit margin, as I talked about, as this is the true number that matters in any business, right? Because it's what you take home at the end of the day. It's what you use to feed your family at the end of the day, pay your bills, etc. So we calculate this by taking our net profit divided by revenue multiplied by 100. So in an example, and again, this is for a period of time. Most business owners only worry about this at the end of the year. But in reality, we should be paying attention to these metrics at least monthly, if not quarterly. So let's say, for an example, we had net profit for the year of $40,000. And our total sales, or our total revenue, was $200,000. This would mean that in this case, our net profit margin was 40, right? And we divide that by the 200,000. So we get a net profit of 20%. And again, the importance of knowing this metric is because it gives you a comprehensive understanding of your business's profitability. It accounts for operating costs, any business taxes that you have to pay, interest, overhead, different things like that. And it gives you a complete picture of how much money you're actually making. A lot of business owners focus on that top line revenue. And they say, I'm $1 million company, but it doesn't matter if you're $1 million company and you're losing money. Because you could also be a $250,000 company and make $100,000 a year. So it truly doesn't matter the overhead and that top line number in terms of revenue. What matters is your net profit. And this is where this metric comes into play. So how do you use net profit in your decision making? So this is a true vital tool for understanding if you have a high profit margin or a net profit margin, right? maybe it's time to reinvest. Maybe there's some capital that in investments that you want to make. Maybe there's a new location you want to open. Maybe you want to start putting away for a rainy day fund. Having a high net profit margin, or a positive net profit margin at least, gives you the room to start making those decisions and thinking ahead. Maybe it's time to reinvest into the business. But all these things, you can't make that decision without knowing how much money is actually there. And that's where net profit margin comes into play. So before we move to the last three metrics, I want to talk about these last two metrics together, because gross and net profit margins, they're both from your financial statements, and they both play an effect on your business immensely. So first, by knowing each, you can identify discrepancies between gross and net profits. So if you have a high gross profit margin, so let's say you are an accountant and you have a net profit of 90%, but for some reason your net profit margin is 5%, where are you losing that 80% in expenses? And it allows you to say, I need to look at my overhead, because I have a high gross profit margin, but my net profit margin is low. So it gives you that initial information to begin to identifying, and it gives you kind of the direction of where to look. Again, it goes back to that compass. It allows you to leverage your gross profit margin for investment in growth. So when you have a positive gross profit margin and you have a positive net profit margin, this gives you the information you need to start maybe improving your marketing, looking into R&D, or expansion into new markets, as we said. So by knowing these two, you can then leverage them. And the big thing that banks are going to look at, or funders are going to look at, or even investors, is what are your margins? And if you don't know your margins and you can't tell them, well, we operated a gross profit margin of 50% with a net profit margin of 10%, trending over the last three quarters or three periods, they're not going to listen to you. They want to know these margins, and you as the business owner need to know them just as much. You can use your net profit margin kind of to fine tune, right? Your efficiency. So if by knowing your net profit margin, and again, if it's lower than what you think it should be, there's probably some efficiency issues that are going on in your overhead. So by knowing the number and the metric, you can then go back and identify areas for improvement. And then finally, by conducting a cross analysis of the two, you can really allocate resources, whether it's to gross profit or whether it's to overhead or to cost of goods sold. You can basically allocate your resources better when you're looking and you're making decisions, ensuring that neither your profitability nor your efficiency in your operations is compromised when you're actually doing that comparison. All right, so next we wanted to talk about, we're going to shift kind of to knowing what is your customer, right? So the first one is customer lifetime value. And customer lifetime value, or CLV as it's so often referred to, is the total worth of a customer to a business owner over the entirety of their relationship with the business. So we calculate that by customer value times customer lifespan. So for an example, let's say that customer buys from your business on average $100 per month, whether it's a membership fee, maybe they come in and they're buying from your store, et cetera. And they have a 5-year loyalty period. So we figure out their customer value by taking the $100 per month, multiplying that by 12 months in a year, and then 5 years. So that means that this customer has a $6,000 lifetime value to this business owner. So the importance of knowing this, or knowing your CLV, will give you the understanding that you need to know how much value every single customer brings to your business in the long run on average. It informs you how you should be spending your marketing. It informs you how your customer acquisition strategies are going. And it will let you know about your customer service initiatives. Do you need to invest more, right? Because the three things that really, as you can see, the three things that make up your customer lifetime value is, what is the average purchase price, okay, that they buy from you? How frequently are they buying from you? And then how long are they staying with you? And by looking at those three areas, you can then understand and impact those, right? So, if you want to increase, the average spend, that's where, maybe some upsells of additional products or, that are important to them and value to them. So, doing some upsells, maybe even some cross sells, where you're partnering with other people, or providing an additional operation or product to give to them as a cross sell to increase that spend, and maybe even downselling sometimes. Maybe they come into your business 3 or 4 times a month, but typically only buy twice. Maybe there's a downsell that you can offer in those other times where they're not buying from you. So knowing these things to increase the average purchase price, there's also ways for you to increase the frequency. There's also other ways for you to increase the lifespan as well, but obviously this is not what this training's for. But knowing the CLV and knowing whether it's higher or lower than either one, your industry, right, and two, your expectations, you'll know what to look into. And again, how does it drive your decision making? So understanding your CLV is going to allow you to make informed decisions related to retention. So again, we talked about retention. How do you keep them longer? And upselling efforts. We talked about upselling. It also indicates if you have the leverage, right? And we'll talk through this when we talk about our next metric, customer acquisition. But it indicates whether you have to invest more in acquiring or if you need to invest more into keeping your current customers. Because if you have a low customer lifetime value, then you may want to focus more on keeping those customers. But if you have a high customer lifetime value, you need to spend more time bringing more customers into your business because of the high value that they're bringing to your business. So understanding not only CLV, but then customer acquisition costs, which is in our next slide, in tandem, and we'll talk about that as well, are going to be paramount to your success. So as mentioned here, we have customer acquisition costs. What does it cost you to win a customer to come into your business? And it quantifies the total costs that are incurred to acquire a new customer. So in this case, it's total cost of acquisition divided by the total number of customers acquired during that period. So let's say for a quarter, we had a marketing spend of $10,000 and we acquired 100 new customers from that campaign. So we would calculate our customer acquisition cost as $10,000 divided by 100, or $100 per new customer. So why is this important? It's crucial for your marketing budget, for your planning when you're thinking of campaigns that you want to put together, and then also scaling your business, right? If you know that you want to grow and you want to scale your business and you want 1,000 new clients, well, you know that you're going to have to spend $100,000 to get those 1,000 new clients. As in our example, you have $100 per new client, because you would just take that $100 times 1,000, and that would get you $100,000. So how would you use CAC in decision making? Your customer acquisition costs. It allows you to really guide, right, whether you should be spending more time on acquisition or spending more time on retention. A high CAC may indicate the need for you to improve your marketing efficiency or focus on retaining your existing customers. So if you have a cost of acquisition of $500 currently per new client, but that client only brings you in 1,500, but your current customers, you have the opportunity to increase their lifetime value by 2,000. Maybe you need to spend more time, improving your current customer base than trying to get in new customers. But on the flip side of that, if you have a low customer acquisition cost of, like, say, $40 or $50 per client, and those clients bring you in $3,000, $4,000, $5,000, then obviously it's a no-brainer that you just need to be bringing in new clients and new customers, because of the lifetime value that they're bringing to your business. So by knowing your customer acquisition cost and then in tandem knowing your customer lifetime value, you can make better decision making. So as mentioned, how do you use these two together, right? How do you truly master your customer lifetime value and your customer acquisition cost? So first is knowing the ratio. One key approach is to look at the ratio between customer lifetime value to customer acquisition cost. A higher ratio indicates a healthier business and a more efficient customer acquisition and retention process. Generally, as a rule of thumb, you want to have at least a 3-to-1 ratio. So you want to have a value that is 3 times bigger than the cost it takes to acquire that customer. But in general, you want to see more, you may see in your business more 4, 5, 6, 10 times, the cost of acquisition. Once you get below that 3-to-1, Then you really need to identify, am I overspending on my marketing? What's going wrong with my marketing? Is it, am I not getting the views? Is it the copy? Is it the medium? All these things, knowing this ratio between the two can kind of drive that decision, and basically help you understand when you need to shift strategies. By understanding the two, you can truly allocate your marketing budget more efficiently. You'll know exactly how much you should spend and be willing to spend on a new customer. So just by knowing your customer lifetime value, you can then understand how much you want to spend to acquire that person. So let's say you figure out that the average customer lifetime value is worth $1,500 to your business, and you want to have a ratio of 5 to 1. Well, you know that by using that ratio, dividing the 1,500 by 5, you know that you only want to spend $300 to bring in a new customer. So you can efficiently kind of plan, right, your budget. And what you then do is then you can say, all right, well, I need 100 customers to be successful, right? Because then I'll have $150,000. And then you take the 150 and then you times it by, the 3,000, and you're the 300, and you realize that, well, I need to spend $30,000 on marketing. And do you have that 30,000 to spend on marketing to bring in those 150 clients? So it allows you to really understand where you are and where you need to be budgeting and funding your marketing operations. It gives you a balance, right? So how do you balance between the two? If your customer acquisition cost is high, but your CLV is low, as we've said a few times here, then this is truly the sign where you need to begin focusing on retention, increasing that lifetime value, whether it's retention, whether it's frequency, whether it's a higher purchase price. So focusing on those strategies versus acquisition. Whereas if you have a high lifetime value and your acquisition costs are low, this is when you really need to spend and focus your attention on bringing in new customers, because the lifetime value that they're bringing to you far exceeds the acquisition cost that you have to pay to bring them in. And then finally, knowing these two, it will help you and inform you on product development and upselling. For instance, you can tailor new products or services so that they have a higher customer lifetime value, and thereby making your acquisition cost for those products or services more justifiable. So if you're coming out with a service that is worth $6,000 a year to the business, but you know that you're going to have to spend $1,000, $1,500 to bring that client in, then it's worth it, because in the long run, if that client is with you because you're taking care of them and you're adding value, like we always say, then that customer is going to be with you for year over year over year, and you only have to pay that acquisition cost once. Now, yes, of course, you're going to have to pay some retention. Do you have strategies related to customer retention? But when you're looking at your lifetime value versus your acquisition cost, the cost to get them in the door, you want to have that your ratio. And this, by knowing these two metrics, will allow you to be informed to make better decisions around your marketing strategies. Finally, we want to talk about return on investment. And return on investment is very simple. Whether you're making a capital improvement, a marketing campaign, or just any investment into your business, you want to know, was it worth it? So you take your net profit from that investment divided by the cost of that investment, multiplied by 100. So let's say we invested in a $5,000 marketing campaign, and we got net profit from that campaign of $15,000. So you would take the 15,000 divided by the 5,000, or you would get a 300% ROI return. And obviously, anything with a positive means that you've made money off of that investment. It's a good decision. If it's a negative, means you lost money. So the importance of knowing your ROI is crucial for evaluating the efficiency and value of any investment that you're willing to make, whether it be a marketing, equipment, or a hire. A lot of people don't think of ROIs when it comes to hire, but when you think of an individual who you want to bring into your company, and it's not even the person, right? It's the position, and you're willing to pay $50,000 for that position, add 30-40% for, taxes, benefits, all that fun stuff. So you're paying more like $75,000 for that position. You want to know, is that going to give me a return? So if it's a revenue generating position, in order to be a positive ROI, you have to have expectations of revenue or profit brought in from that position of at least $75,000 to be positive. That's break even, right? So it allows you to kind of evaluate when you're making these decisions. Am I making positive ROI decisions, or am I making negative ROI decisions? So how do you use the metric, right, in your decision? So using ROI is a good gauge of future investments. And it's also a way to evaluate your strategic decisions. So when you're thinking about, all right, well, we need to invest in a new piece of equipment, a lot of business owners just fall back, well, we need it. Well, if you think about what is my ROI from this piece of equipment, then one, it helps with your funding opportunities because you can actually show that to the funder and say, look, we need you to invest in us so that we can invest in this piece of equipment. It's going to give us an ROI of 400%. And also you can evaluate on your end when you're deciding between two projects, right? Maybe you're talking about two different campaigns or two different pieces of equipment. One may give you a 500% ROI. The other one only is going to give you about a 300% ROI. While both are positive, it's good to understand why they're different. So by knowing ROI, you can understand that. All right, now we've covered the 6, and I know there's probably going to be questions. So again, as I mentioned, at the end of this video or down below in the description is my contact information. You can reach out to me at any time to ask any questions on any of these metrics, and even talk through your specific business situation and how we can implement these metrics in your business. But I want to talk about a couple examples just to get your mind thinking about how these work, right? And how you would use this information in your business. So in our first scenario here, we have your company is looking to spend and budgeted $20,000 for marketing. One option for a proposal that you received comes with a higher customer acquisition rate, but comes with a cost of $15,000. And it's going to bring you in 100 new customers. And the other is a more budget-friendly option at $10,000, but is less effective by only bringing in 50 new customers. So the first question is, how would you evaluate each option in terms of customer acquisition cost? And what you would do here is you want to take each option and figure out what is our CAC. So if we look at the first one, right, we want to take the 15,000 divided by 100 new clients. And we figure out that that is going to result in $150 per customer CAC. But if we look at our second option, while we may think it's more budget friendly because it saves us $5,000, it actually costs more cost. If you take the $10,000 divided by the 50 new customers we're going to get off of this campaign, that means that we have a CAC of $200 per customer. So we're actually spending 33% more per new customer by going with the budget-friendly option versus the first option. So this is where you need, by understanding what am I doing with the customer acquisition cost and what that metric means, you can start evaluating proposals more effectively. The second question is, what other metrics could you consider using before making a decision, right, on which option to go to? So some options here, one would be ROI, right? Considering what are the customers that are being brought in, what are the sales going to be from that customer, what are the cost of goods sold? By understanding your ROI for each one of these, because they may be marketing different products, understand the ROI. Your lifetime value, again, knowing which customers are being, one, marketed to, and two, that are going to be, the 100 that are brought in. So let's say the 100 in the first option is a lower lifetime value than the 50 in the second option. If that's the case, then you need to make the determination on which marketing plan you want to go with. Do we want to market our higher lifetime value, or do we want to market our lower lifetime value, but get more customers, right? So this is where all these things are used in tandem. So which option, right, would be best in this scenario? And again, this is kind of a trick question only because like there's a lot of other things that need to be known in order to truly make an informed decision. To just make it off of customer acquisition cost alone is not going to be the best decision for any business owner. So when evaluating these campaigns, for simplicity purposes of this example, we're going to assume all the other variables are the same, right? The customer lifetime value the same, the ROI percentage the same. So in this case, the best option would obviously be option one, because you're saving that $50 per new client being brought into your organization. But it is important to know all of the other metrics as well related to this before you make the decision so that you can make the best decision for your business. So let's move on to example number two. Your business offers two products. The first product costs you $10 to make, and it sells for $20. However, product B costs $15 to make and sells for $25. So the first question that I have for you, and pause the video since you're watching this as a recording, which of these products has the better gross profit margin? So how would we figure that out, right? So we want to take your gross profit, which is your revenue, right? So let's say for product A, which is our revenue of $20, we minus the $10. So that gives us a $10 difference. And we're then going to divide that by our revenue, so $20. So in this case, product A has a gross profit margin of 50%. Product B sells for 15 and sells for 25, right? So we want to take the $25 minus the $15 it costs to make. So again, it's still $10, right? The dollar amount is still the same, but our gross profit margin is actually now only 40%, because when you take that 10 and divide it by 25, which is our revenue, we have a 40% gross profit margin. So in this, to answer this specific question, product A provides us the better gross profit margin. Where would you allocate more marketing resources? Now, again, if we were just talking about allocating for gross profit margin, we would allocate our resources towards product A, right? Because it's got the better margin. However, knowing where your market demand is, knowing where your lifetime value is, product B may actually have a longer retention period than product A. So knowing all of these metrics in tandem, again, it's kind of that theme of our conversation here, is that knowing everything together helps you make better informed decisions. And do you think it's a good idea to focus on only the more profitable product, right? So do you want to put all your eggs into one basket? And again, the answer to that would be no, right? You're selling product B for a particular reason. There's a demand for it, whether it's an offshoot product and it's there to make. There's a reason you're creating it, and there's a reason you're selling it. So don't always put your eggs in one basket when it comes to marketing. You may give product A a higher proportion of the marketing budget, depending on all the other variables, but always be willing to invest in marketing in all of your products. So before we wrap up, I want to talk about some common pitfalls that a lot of business owners make when using metrics, whether these six or metrics in general. And first is ignoring the context. Remember, these numbers don't exist in a vacuum. They're always bigger, broader business context when interpreting numbers. So for an example, let's say you have a high customer acquisition cost. If I tell somebody that there's $1,000 customer acquisition cost, that may seem troubling. But if the lifetime value is much higher, then it's less of a concern. If I have $100,000 lifetime value and I'm spending $5,000 in marketing or customer acquisition, that's not that big of an issue. Whereas if I had a $500 customer acquisition cost and I got $700 in return, that's where the issue is. So knowing the full context that makes up these metrics is important. So don't ignore it. Lack of periodic reevaluation. I mentioned this earlier in the training, is that you don't want to just do this on a yearly basis. Financial metrics are not set it and forget it types of metrics. It's vital to revisit these numbers periodically in order to help you adapt to changing business conditions or even changes in your operations. So example, if your revenue growth rate was 15% last year, don't just assume that things are going to stay consistent. I've talked to many customers and clients who I've asked how they are doing, and they've given me a net profit margin of 15, 20%. And when we go in and we deep dive into their financials, because they haven't done them yet this year, we find out that they're only operating at 5%. And they're confused why, and they don't know why. Don't just set it and forget it, right? You need to be reviewing these numbers on a regular basis. My minimum suggestion is quarterly, but I highly suggest monthly. An over-reliance on a single metric. Each metric offers you a specific perspective, and no single metric can provide the complete picture of your business. So it's essential for you to consider multiple metrics to make well-rounded decisions. So for an example, if you're focusing solely on gross profit margin, you might be ignoring some other vital metrics like net profit margin or ROI, which can offer deeper insights into your total business health. Remember, gross profit margin only looks at, the top portion of your P&L. So how profitable is my product, or how profitable is my service? It doesn't tell me how profitable my entire business is. So knowing metrics and using them as a combination in decision making is important. But the pitfall here is that many business owners just focus on one, and that's it. They don't want to look at any other ones. And this is a mistake. And finally, a misinterpretation of the data. Be cautious about making conclusions based on raw numbers. Always spend the time putting in some analysis into the outcomes that you get with your metrics. Misinterpreting the data can lead to flawed strategies and missed opportunities down the road. So for an example, you may be seeing a declining net profit margin, and it might seem like a red flag, but it could also be due to the fact that you've made short-term investments that are going to lead to long-term profits down the road. So knowing what underlies and how each one of these metrics is made up and the data that goes into it is going to help you make sure that you don't fall into this pitfall of misinterpreting the data. All right, we've reached the end of our training today. I hope everybody has a wonderful and amazing week. If there's any questions on the next slide here, what I want you to do, this is your interactive portion of the video. And I want you to pull out your phone, or if you're watching this on your phone, take a screenshot of this QR code. It's going to pull up your text messaging app. I want to have a virtual coffee with you, because if you've taken the time to get this far in the video, you are truly intrigued by these metrics and how they can impact your business. Let's have a virtual coffee together, how we can, one, understand your business, and two, how can these metrics impact your business? So send me a text message. It'll pull it up, and all you got to do is enter your name where it says XXX. Enter your name, send me the text message, and we'll get connected for a virtual coffee session to talk about how we can help you implement these metrics in your business. Or if you can't send a text message, remember, you can email me at info@triumphcoachinggroup.com, or I'm going to give you my cell phone number, 216-702-1779. Feel free to text me. Feel free to call me anytime, so we can talk through these metrics, how we can implement them in your business, and how these metrics can change and transform your business. So remember, implementation is the key. Take this information, go back, start implementing it in your business, and you'll start to see huge financial changes. So let me know how I can help. Here's to your success. I hope you have a wonderful and fantastic rest of your day. Talk to you soon. Okay, there you have it. I hope you all enjoyed that video training series on the 6 key metrics that we feel you need to have and be monitoring on a regular basis to impact and transform your business. So as mentioned during the training, please scan the QR code. I'll also include a QR code, or at least a link to the virtual coffee down below in the description. Make sure you schedule your time. It's complimentary. Let's have a chat about how we can help you grow and transform your business. I look forward to talking with you, and I hope you all have a wonderful and great rest of your week. Talk to you soon.